Hi, this is Lori Hiscock with Ruoff Home Mortgage. If you're considering a home purchase in the state of Indiana, then you should understand how property taxes work here. You should know how they work, how they're calculated, and most importantly, how they can impact the monthly payment on the home you buy. So let's take a minute to talk about these. To start with, let's talk about what property taxes are. Property taxes are an annual tax bill you get, very much like your income taxes. They are calculated every year on the property that you own, and the money from those tax bills is used to pay for things like our schools, our police, our fire department, our libraries, our road care, things like that. Every home has slightly different property taxes because they're based off different things. The property taxes on the home you buy are going to be based on the assessed value for that home, as well as the tax rate assigned to your home and any deductions you may have on the tax value. So let's start at first by talking about the property value. You may have heard horror stories in the past about property values changing dramatically on a new tax bill, and people's tax bills going up sometimes by 50% or even doubling in one tax year because of that dramatic change. That has been a problem in the state of Indiana, but it has been mostly rectified in the last few years. It used to be that our properties were all assessed once every 5 to 10 years. The county assessor would go out and assign a value to each home. Well, as you can guess, if that's only done once or twice a decade, that value may be significantly different than the last time it was done. That would make people's tax bill change significantly. To avoid that happening, the counties have now begun doing what's called trending. Trending is where they reassign a value to the home every year, and that new value is based off of the recent sales data. So where it used to be only once every 5 or 10 years, now every year your home's value will change a little bit based on what has sold near it. Once the value is determined for your home, then a tax rate is going to be calculated. The tax rate is based on the budget for the area where you live. The county and the township will determine what they need for their police, their fire, their road maintenance, their schools, their libraries. They'll calculate the total amount needed, making sure it stays within the laws of the state on how high those budgets can be, and they'll then divide that out by the total value of the real estate in their area. That way they assign a portion of the amount needed to each homeowner in the area, and that's what your tax rate is. It's your portion of that bill. So now you have an assessed value for your home and you have a tax rate. So you would think calculating the bill is very simple. Take the value, multiply it by the rate. There's one other component though that's a very important component, and that's called exemptions, also known as deductions. You can get a reduction in the assessed value of your home based on various things. For example, veterans get a deduction. People who are over a certain age with a certain income can get one. If you're blind, there's a deduction. If you have a mortgage on your home, you can get a deduction. There are multiple reasons that your tax assessed value could be lowered with these deductions. The biggest one by far, though, is the homestead exemption. This is a deduction you get when you own a home that you actually live in. If you're a landlord, you don't get this. If you're a foreclosing bank, you don't get this. But if you are an owner occupying your home, you get lower property taxes because of that. So how does this impact most home buyers? Well, I will often see home buyers looking at homes, and they do look at the property taxes and find a home they like, but the taxes seem crazy high, so they rule it out. Understanding how the tax bill is calculated, though, helps you know whether you should rule it out. It may be that that assessed value is just very high. You could be buying the home at $100,000 and the assessed value is $180,000. Well, if that's the case, the assessed value can be disputed. There are forms you can file that will help bring that back to the appropriate amount. You wouldn't necessarily want to rule the home out for that. More likely, though, if the taxes seem high, it's because the exemptions are off, specifically the homestead exemption. The current owner could be an estate selling a home from a deceased relative. It could be an owner who has moved and taken their homestead exemption with them to their new home. It could be a foreclosure or something along those lines where the owner is currently not living in it. Because of that, the homestead exemption is off. When you buy the home, though, you qualify for the homestead exemption immediately. It takes effect as soon as you buy it if you are going to live in that home. So you don't want to rule that house out just because taxes are higher if that's the reason. So how are you going to know if the taxes are higher because of that? That's where your realtor comes in. They can look at the information and let you know the exemptions are off, the assessed value is high, whatever it may be. They can also work with you and the title company to find out what the property taxes would be in your situation as an owner-occupant. So please make sure you don't rule out homes just because the taxes seem high. It very well may be much lower for you. Well, if you have any questions on property taxes or on any other aspect of home financing, please know I'm always happy to help. Just give me a call or drop me an email. Thanks and have a great day.